Hello, my dear students. Today we are going to cover the Excel part of the stock valuation chapter. Let us start. Here you can see income statement and balance sheet for a particular company for the year 2021 and 2020. And then based on the information, we need to first calculate the free cash flow to the firm for these 2 years. And then we are going to forecast free cash flow to the firm for the same company for some future years. And then based on the forecasted free cash flow to the firm, we're going to calculate intrinsic stock price. We're going to also perform sensitivity and scenario analysis of this intrinsic stock price at the later part of this Excel sheet. Then let us start. So first, let us calculate the free cash flow to the firm for the year 2020-2021. Here you can see the equation for free cash flow to the firm is net operating profit after tax minus investment in operating capital. Then investment in operating capital also have two components. One is investment in net operating capital. One is net operating working capital, and then the other one is net property, plant, and equipment. All right. So first, let us calculate net operating profit after tax. And the formula is earnings before interest and tax adjusted for the tax rate. EBIT times 1 minus tax rate. And here our tax rate is 25%. Again, EBIT times 1 minus tax rate for the year 2021. So now we got one component of free cash flow to the firm. The other component is investment in operating capital. And then to get this particular component, we need to calculate net operating working capital. This net operating working capital is the difference between operating current assets and operating current liabilities. And operating current assets include all components of the current assets except for the short-term investment. So let us first calculate operating current asset equal sum of cash, accounts receivable, inventories. Then operating current liabilities include all current liabilities accounts except for the debt accounts. Sum of accounts payable and accruals. Now, net operating working capital is the difference between operating current assets and operating current liabilities. Now, let us calculate total net operating capital. It is the sum of net operating working capital we calculated above and net property, plant, and equipment, which we report under the long-term assets of the balance sheet. As you can see here. Next, total net operating capital. Now, investment in operating capital equal the difference between investment in the difference between total net operating capital in the year 2021 and the same account in the year 2020. Now, free cash flow to the firm, it is net operating profit after tax for the year 2021 minus investment in operating capital, negative 210. Next, return on invested capital. So it is net operating profit after tax for every single dollar investment in total net operating capital. So here is our net operating profit after tax over total net operating capital, 3,000, 10%. Now, operating profitability ratio. And this ratio measures the amount of net operating profit after tax we generate for every dollar of sales revenue over sales revenue then capital requirement ratio. So capital requirement ratio is total net operating capital over sales revenue. That means our investment in total net operating capital for every dollar of sales revenue. Now here, total net operating capital over our sales revenue. Right. Now, we have several assumptions for the free cash flow to the firm in the coming years. It says sales growth in the first year is 10%. Sales growth in the second year is 8%. Sales growth in the third year is 7%. Then long-term growth will be 5%. And then operating profitability capital requirement ratio will remain the same as the year 2021. You can see here 6% operating profitability ratio and 60% capital requirement ratio. And then weighted average cost of capital is expected to be 11.5%. Now, based on all of this information, let us now forecast free cash flow to the firm for the future years. Okay, so our base year is the most recent year. That means it is year number 0. Right? And then let us now copy the numbers for different accounts for this base year. So net sales for 2021 is 5,000. And then total operating profit after tax, which is no PET, then total net operating capital, $3,000, and then investment in operating capital, $510. All right. Now, let us calculate, let us estimate these account numbers for all the other years in the future. So here, net sales is expected to grow by 10% in the very first year. And then it is expected to grow at the rate of 8% in the year 2023. And then it is expected to grow at the rate of 7% in the very third year. And then after year number 3, this net sales is expected to grow at 5% rate for indefinite time period. So let us calculate this, the sales, net sales using this long-term sales growth rate for just 1 year. And then you're going to see later on, we're going to apply the constant growth model formula to capture this long-term sales growth for indefinite time period. Okay, so now you got all of your forecasted sales number. Then net operating profit after tax. You can see here the operating profitability ratio is how much? 6%. So your operating profit will be 6% of your net sales. Then total net operating capital. So here you can see your capital requirement ratio is how much? 60%. That means your total net operating capital as percentage of sales should be 60%. Now, investment in operating capital, which is the difference between total net operating capital in the current year and the same account in the previous year. Okay. Now, free cash flow to the firm, which is the difference between net operating profit after tax and your investment in operating capital. All right, now terminal value. Now it says your sales growth will be 5% forever. And then remember here, your capital requirement ratio and operating profitability ratio is constant. So that means this 5% growth in the net sales should be your growth in the free cash flow to the firm. So here, our free cash flow to the firm is expected to grow at the long-term sales growth rate forever. Then we can apply the constant growth model formula to calculate the value of the firm for this constant growth rate period. So the formula is, remember FCF0, that means FCF in the current time period. In this case, it is 2025. Write down the formula. So it is FCF in 2025 times 1 plus growth rate, and then WACC minus growth rate. And then you are going to always get value 1 year backward. That means you are going to get value in the year 2025. Why? Because remember, once you grow free cash flow to the firm, in the year 2025 by the growth rate, you actually get free cash flow to the firm in the year 2026. You get 1 year value backward, right? So value should be in the year 2025. 1 year backward of the year 2026. All right. So let us calculate. 2010, 1 plus growth rate 5% over WACC minus your growth rate. Right. So terminal value here is 3388. Now, let us sum up the cash flows in every single year. So remember, in the year 2022, your free cash flow to the firm is just 30. In the year, you don't have any terminal value. And then in the year 2023, you just have free cash flow to the firm, no terminal value. In the year 2024, again, you have free cash flow to the firm, but no terminal value. In the year 2025, you have both free cash flow to the firm and terminal value. So sum of your cash flow should be the sum of free cash flow to the firm and terminal value. So equal sum of these two numbers. Let us drag it down for all the other years. Now we are going to calculate the discount factor. Remember, the future value from the present value formula is future value in the time period t over 1 plus your discount rate, whatever is your discount rate. In this case, our discount rate is weighted average cost of capital to the power t. Now, our year 2022 is our first time period, right? First year. Then 2023 is our second time period. 2024 is our third time period. 2025 is our fourth time period, right? Okay. And then how we get it? It is the difference between the base year and the year in which we are making the forecast. Okay. So, and then here the discount factor is this part, 1 over 1 plus WACC to the power t. So we are now putting this into this Excel formula. So 1 over 1 plus WACC. Let us make it constant to the power the forecasting year minus the base year. So base year should always be constant, right? Because we just have one base year. Okay. Then present value of our free cash flow or total cash flow, whatever it is. Total now you can see here. So we get present value by multiplying the future value with the discount factor, right? We already know our discount factor for all the years, and we also know our future values. In this case, our future value is our sum of the cash flows. So equal our sum of total cash flows multiplied by the present value discount factor. Right. Then sum up all the present values. Then you're gonna get value of operations. All right. Then from value of operations, we can get total intrinsic value. So value of operation plus our short-term investment in the base year will give us our total intrinsic value. So short-term investment is reported under the current assets section of the balance sheet. It is 10. So let us now calculate our estimated total intrinsic value. Now, this total intrinsic value is applicable for three types of securities holders. One is what? One is common shareholders. Another one is debt holders. The other one is preferred shareholders. So once we just remove the value of debt and preferred stock from the total intrinsic value, then we are going to get what? The value applicable for the common shareholders. Is it clear? Then we're going to get the intrinsic value of total common equity, and then we divide the intrinsic value of total common equity by the total number of shares outstanding to get intrinsic stock price. That means intrinsic value per share. Okay. So first, let us calculate value of our total debt. We have some short-term debt, we have some long-term debt in the base year. So short-term debt is notes payable, and long-term debt here is long-term bonds. Okay. Then preferred stock is 100 in our base year. Now the estimated intrinsic value for the total equity. So total intrinsic value for the equity holders is 1,764. Now let us collect number of shares outstanding. And here, number of shares outstanding in the base year is 60. Then the estimated intrinsic stock price is the total intrinsic value for the common shareholders divided by number of shares outstanding. In this case, it is $29.40. Okay. Now we are gonna estimate the sensitivity of this stock price to long-term growth rate and then operating profitability. To do so, first of all, let us first copy our base rate. So our base rate, that means the rate we use to estimate this intrinsic value. And then for long-term sales growth, it is 5%. And then for operating profitability, it is 6%. Okay. Now, to the left-hand side of our base rate, we are going to reduce this rate by 1% every year. And then to the right side, we are going to increase this rate by 1%. The same way, we are going to reduce the operating profitability once we go up from the base rate. And we are going to increase the operating profitability by 1% once we go down from the base rate. All right. So next step is to convert all of these numbers into text so that there is no formula involved. So I just copied it first, Control C, copy, and then here paste as text. The same way, I'm gonna copy it and then I'm gonna paste as text. All right, now to the left top corner, we are gonna copy the stock price we estimated. And remember, this should be linked, right? So you can see I linked this one. All right, now we are ready to perform the sensitivity analysis of the intrinsic stock price to these two factors, including the long-term FCF growth rate and operating profitability ratio. Okay, then go to data, then from what if analysis drop-down menu, click on the data table and then row input. So here you can see in the row, you put long-term growth rate. From the assumption section, select long-term growth rate. And then on the column section, you can see you put operating profitability ratio. So select the operating profitability ratio for the column input cell. Operating profitability ratio, 6%. And you're gonna choose all of these numbers from the assumptions section. All right, then hit OK. Now you can see here, whenever your operating profitability is 6% and then long-term growth rate in FCF is 5%, your intrinsic stock price is $29.40. That is exactly what you calculated here. Then you can see here, as growth rate goes up, stock price goes up. The same way as growth rate goes down, as you can see here, stock price also goes down. On the other hand, for operating profitability ratio, you can see here, as operating profitability goes down, stock price goes down. As operating profitability goes up, stock price goes up. So operating profit, the intrinsic stock price has positive sensitivity to both long-term growth rate in the free cash flow to the firm and operating profitability ratio. Right, now let us perform scenario analysis under 5 different scenarios. These are the base year, right? For sales growth rate in first year, sales growth rate in second year, sales growth rate in third year, long-term sales growth rate, operating profitability ratio, and then capital requirement ratio, and then weighted average cost of capital. Okay, to do so, I'm gonna copy this number to the area right beside this assumption section. Now, remember, we calculated our intrinsic value based on these assumptions. So you're gonna just select all of these assumptions and then go to what if analysis, scenario manager, and then here you're gonna add up all of these scenarios. So add, our first scenario name is higher sales growth only. Higher sales growth rate only. And then we're going to perform this scenario by changing sales in the assumption section. Then hit OK. Now put the value of the same factors you have in your second scenario. So you can see here our sales growth rate in the first year is expected to be 11%. So it is 0.11. Sales growth rate in the second year is expected to be 9%. Sales growth rate in the third year is expected to be 8%. Then our long-term sales growth is expected to be 6%. Then the capital operating profitability ratio is expected to be 6%. Then the capital requirement ratio is expected to be 60%. Weighted average cost of capital is expected to remain the same as 11.5%. So we put now all the numbers under the new scenario, then hit add button. Now let us put the second scenario name. In this case, it is higher operating profitability. Higher operating profitability. Again, we are going to perform this scenario analysis by changing the cells in the assumption section. Then hit OK. Then let us put all the numbers: 10%, 8%, 7%, 5%. This one should be 7%, the operating profitability. Then other factors should remain the same as it is. Okay. Then add another scenario. Our next scenario is better capital utilization. Better capital utilization. Again, we are going to perform this scenario by changing the cells in the assumption section. Hit OK. Now put new number: 10%, 8%, 7%, 5%, then 6%. Next one should be 51%. And then weighted average cost of capital should be 11.5%. Now add new scenario: improve growth and operating profitability. Improve growth and operating profitability. Hit OK. So first one is 11%, next one is 9%, next one is 8%, next one is 6%, next one is 7%, then 60%, and 11.5%. Then add the sixth one: improve growth and CR, capital requirement ratio. Again, 11%, then 9%, then 8%, then 6%, then 6%, then 51%. Then hit OK. So now we have our 5 scenarios. Now we're going to perform this scenario analysis. Hit summary. And then we want to change this intrinsic stock price. That means we want to see the changes in the intrinsic stock price under each of this scenario. Then hit OK. You can see our base price is $29.40, and then we got a stock price under each of these scenarios. You can do the same scenario analysis for intrinsic value too. And I'm going to leave that for you to practice at home. So at home, you're going to practice how to perform this scenario analysis for the intrinsic value, not for the stock price. Right. Next, we are going to perform the stock valuation based on the forecasted dividends. Okay. Here, your current dividend is 2.4%, and then your dividend growth rate is 5%. This dividend growth rate will continue forever. Then your required rate of return is 13%. Now the question is, what is your dividend next year? And then what is your stock price today? So dividend next year is D1, right? And then to get D1, you need to grow the current dividend by the dividend rate. So here, our current dividend is $2.40. And then our dividend growth rate is 5%. So this is how we get our dividend 1 year from now. Next, our stock price today. So it is a constant dividend growth rate problem. So we are going to apply this constant growth rate formula to calculate stock price. Equal dividend in the next year over the difference between cost of equity and long-term dividend growth rate. So our stock price today should be $31.50. Okay. Next, now we are going to have non-constant dividend growth rate. Now we can see here our dividend growth dividend in year number 1 should be $1. Dividend in year number 2 should be $2. Dividend in year number 3 should be $2.50. Then it says this third year dividend will grow at 5% after year number 3 forever. So for this indefinite time period with constant dividend growth rate, we can calculate the terminal value. And we are going to get that terminal value in year number 3. Why? Because remember, our dividend in year number 3 will grow at the constant dividend growth rate. So with the constant dividend growth rate, we are going to get D4 by growing D3 at the constant dividend growth rate. Once you apply the constant dividend growth rate formula using the dividend 4 years from now, you're going to get value 1 year backward. That means you're going to get price in year number 3. Okay, so let us now plug in all the numbers. So we know our dividend 1 year from now, we know our dividend 2 years from now, we know our dividend 3 years from now. At the same time, now we're going to calculate the terminal value, that means price in year number 3. So we're going to grow dividend in year number 3 by the constant dividend growth rate of 5%. And then divide the factor by the difference between cost of equity and the constant dividend growth rate. Right. So our terminal value here is $52.50. Now let us calculate sum of our cash flows, which is the sum of dividend and terminal value. Next, present value factor. I showed you the formula in the previous sheet. So 1 over 1 plus the discount rate. In this case, is cost of equity because you are discounting dividend. To the power time period. Next, present value of our cash flows. Sum of cash flows times the discount factor. This is how we get present value of the cash flows, and the current stock price should be the sum of the discounted values. So current stock price here should be $43.88. All right. Now here, again, we have non-constant dividend growth rate problem. In this case, our initial growth rate here is 20%, as you can see. And this growth rate will continue for the next 5 years. Then we are going to have our second growth rate, 4%. And this growth rate will continue forever. So in this case, you can see in this timeline, we have this supernormal growth rate of 20% from year number 1 to 5. And then right after year number 5, our constant dividend growth rate will start, and it is going to continue forever. So we can apply constant dividend growth rate formula for this constant growth rate period, then you can see here. So once you calculate the value for the constant growth rate period, you're gonna get value 1 year backward. That means you're gonna get your price for the non-constant dividend growth rate period in year number 5. And then you are gonna manually calculate dividend for the super normal growth rate period. And then you're gonna discount all of these cash flows back individually to the current time period, and the sum of all the discounted cash flows here should be your current stock price. All right, let us then do it. The dividend growth rate in year number 1 should be 20%. And we're going to have the same dividend growth rate for the next 5 years. Then our dividend should be, in year number 1, should be our current dividend times 1 plus dividend growth rate. Again, dividend growth rate in the previous year, 1 plus your dividend growth rate. These are continue. Then your terminal value. So we are going to get our terminal value in year number 5 using the dividend for the very first time in the constant dividend growth rate period. So our first dividend during the constant dividend growth rate period occurs in year number 6. So we are going to calculate D6, and then we are going to divide it by the difference between the cost of equity and the constant dividend growth rate. Now you know D6 here is equal to D5 1 plus with dividend growth rate. So you're gonna grow the dividend in year number 5 by the constant dividend growth rate to get the very first growth rate in the constant dividend growth rate period. So here our constant dividend growth rate is 4%. So we got our D6, right? Then divide it by the difference between the cost of equity and constant dividend growth rate to get your terminal value. So a terminal value here is $86.26. So this is the formula we applied here, right? To get this terminal value. Next, calculate sum of the cash flows. Then calculate the discount factor. Then calculate the present value of the total cash flows. Then the sum of the discounted cash flows should be the current stock price. So here, the current stock price should be $66.64. All right. Now, if I ask you what should be the stock price 1 year from now, then you're going to grow this current stock price just once with the required rate of return. So stock price 1 year from now should be $73.31. So it is your price in T should be your price right now 1 plus your cost of equity in this case to the power the time. So now you can see here, if I want price 2 years from now, it should be P2 equal P0 1 plus required rate of return, in this case cost of equity to the power 2. So here P0 times 1 plus required rate of return to the power 2. Is it clear? All right. That's all for today. Thank you.